It's been a huge week for markets, from geopolitical surprise out of Europe to gold surging to GDP growth accelerating faster than anyone expected. Let's break it all down. Welcome back to Navalier Market Buzz, and make sure to stay with us until the end. We're celebrating 5,000 subscribers with a special giveaway. Dad, a lot happened at Davos last week. Can you please sum it up for our viewers?
Well, President Trump, Treasury Secretary Scott Bessent, and Commerce Secretary Howard Lutnick all made it very clear that globalism is dead, okay? That outsourcing to the cheapest provider destroys countries, it hurts your workers. And they went to Davos to send a message, and they got it loud and clear. Obviously, it was overshadowed by the Greenland news that President Trump would like to buy Greenland from Denmark. And he was threatening tariffs, but he backed off. And then we now have a framework to negotiate a purchase of Greenland. Now, President Trump wants to put this very large missile shield based in Greenland. The sparring among all the political elite was quite interesting. Prime Minister Carney in Canada is still not siding with America, he's siding with Europe. So President Trump has called him out on that. He called out French President Macron, although we did admit he liked his aviator sunglasses. And then when Howard Lutnick was talking, Al Gore shouted out that at the end, and Christine Lagarde, the head of the European Central Bank, got up and left. So obviously they went to Davos to make it clear that they're not going to be pushed around by the global elites anymore. They don't think they should do what they want everybody to do. Larry Fink, the president of BlackRock, was a co-chair, and he in the past has embraced ESG and other things that the Trump administration is not embracing. So things are shifting and shifting fast, and I find that very interesting. Now, probably the most important thing that was said is President Trump, when he talked on Tuesday, said he's going to make the stock market double from where it was on Tuesday. So far, so good. We're going higher.
Now, third quarter GDP was revised to a 4.4% annual pace, and the Atlanta Fed revised its fourth quarter GDP estimate up to 5.4%. So is a 6% GDP growth not that far away?
Yeah, all we have to do is really fix the housing market. Obviously, President Trump's tried to do that with over $200 billion of mortgage buying in the open market to shove rates down. He wants to give first-time home owners the opportunity to take money out of their 401k without penalty, put a down payment. And prices are moderate in the housing market. So if prices come down just a bit, that would help as well. There's minor other things that have to be fixed, like insurance in some parts of the country. But housing was a 5.1% annual drag on second and third quarter GDP. So it's imperative we fix the housing market if we're going to get to 6% GDP growth.
While the big macro numbers are grabbing headlines, something else is interesting that is happening in the market. Small cap stocks have been on a tear. Why are these small caps suddenly doing so well?
For a variety of reasons. First, you're showing a bespoke chart that shows just how much they went up, and the smaller they are, the bigger the bounce. They're obviously hypersensitive liquidity. We've got a lot of money pouring into the market. Small caps are more domestic. Half the sales of the S&P are outside of America. The economy is much better in the U.S. than outside the U.S., so small caps have a natural advantage. But we're having a January effect. This is what happens in January. And we had an early January effect in November. So, this is a very, very important. There's a saying that as January goes, the year goes. There's been multiple articles that the first 5 days, 10 days of January signal a strong start for the year. And so there's a lot of reasons to be excited about the small cap rally.
Earnings season really heats up next week. We have a lot of stocks to talk about, so I'll be putting the time codes in the description below if you want to skip around. But let's start out with defense, an area tied closely to both geopolitics and government spending. Let's start out with Northrop Grumman.
Well, their sales are supposed to be up 8.7%. Earnings are supposed to be up about 9%. We have some decent analyst estimates here. Obviously, this is a huge defense company, and they have a good earnings surprise history. So in the last couple of quarters. So I'm expecting another surprise. Yeah, President Trump wants to increase defense spending by 50%, and this company would be one of the beneficiaries.
RTX gives us insight into both defense and aerospace.
Yeah, this is what a lot of people used to know as Raytheon. They've changed their name. They had a huge surprise last quarter. Their sales are supposed to be up 5%. Their earnings are supposed to be down slightly. But, the analyst estimates are fine, and I'm expecting this company to post another surprise. It doesn't hit all the criteria I need to buy a stock because just the candidly, the earnings aren't strong enough. But this, if it keeps surprising like it did last quarter, it's going to show up on my radar.
Boeing's results will be closely watched, not just for defense, but for any signs of operational stabilization.
Well, believe it or not, Boeing's going to have the best results of most of the defense stocks. Their sales are supposed to be up 49%. Their earnings are supposed to be up 93%. The analysts are definitely revising their estimates higher. Obviously, Boeing has a huge commercial aircraft division, and they are making the F-47 fighter jet, and so they got a lot to be excited about, and they make some stuff for space. So Boeing is finally back on track, and they missed last quarter, but the expectations are so strong this quarter. Hopefully, they'll surprise.
And General Dynamics offers a look at defense spending across land, sea, and information systems.
Well, General Dynamics doesn't excite me. Their sales are supposed to be up 3.2%. Earnings is supposed to be down slightly. But they do have a good earnings surprise history, and they will benefit by these big government contracts. I think we probably should just remind everybody what my favorite defense stocks are, and they're in our managed accounts, and recommend our newsletters, of course. And that is Elbit Systems, ESLT, huge order backlog, Israeli company. The one happens to be Helmet, that's aerospace, that's HWM. And then finally, we have Palantir Technologies, PLTR, which is an AI applier and doing a lot of defense contracts right now.
Energy stocks are also flashing strength. ExxonMobil is at its 52-week high.
So here's the deal with Exxon. By far, the most exciting thing that Exxon has going for it is Guyana. That is a big offshore field. It's the most exciting find in the Americas in decades, and they keep increasing it. It's light sweet crude, not the heavy sour stuff that comes from Venezuela. And they're pumping the natural gas back into the wells. They'll eventually be able to tap that natural gas when it's economical. So that's the most exciting thing happening to Exxon. Now, their sales are going to be down this past quarter. Earnings look lackluster, but their guidance will be crucial. The thing to remember with energy stocks is energy prices tend to drop in the fall and surge in the spring. So I would not be surprised if Exxon gets a spring surge. The reason we have this anomaly is there's more people in the northern hemisphere than the southern hemisphere. And the only way we could get rid of this seasonal anomaly would be to move like a billion people to Brazil or Africa or India to undo this anomaly. But what happens in the winter months, people drive less. And of course, the big ice storm across much of the United States is a classic reason why people aren't driving. And Exxon will also benefit from higher natural gas prices because we have the highest natural gas prices we've seen in some time from this cold front.
And Chevron isn't that far behind.
Chevron sales are supposed to decline 4.8% in the fourth quarter. Their earnings are supposed to be down about 28%. So Chevron doesn't look as strong as Exxon, even though they're operating in Venezuela and should be able to expand the Venezuelan operations. But Venezuela takes a lot more work than Guyana does. So that's the main reason that Exxon looks better than Chevron at this time. But Chevron obviously will help increase Venezuela's oil production. A lot of people think it's going to take years to do the infrastructure. But at least they're there now and operating, and I assume some other oil companies will eventually come in. The biggest barrier to other companies coming into Venezuela is they've had their facilities nationalized in the past, and they're owned billions of dollars. So a lot of them are reluctant to go back because they want to get paid for what was stolen from them. But Chevron's there now, and Chevron will be leading the resurgence in Venezuelan crude oil, but it's going to take a while.
Another interesting pocket of earnings next week is data storage, especially as AI and cloud demand continue to grow. Western Digital gives us a read on enterprise storage and cloud demand.
Yeah, Western Digital was the best performing stock in the S&P 500 last year. Believe it or not, their sales are supposed to drop over 20% in the fourth quarter. I think they'll do a lot better than that. Their earnings are supposed to be up almost 9%. It does have positive analysis revisions. It does have a good, steady earnings surprise history. Uh, Western Digital is not strong enough for me to put in my portfolios to that negative sales growth.
And Seagate's results could tell us whether pricing pressure is easing in the storage space.
So Seagate is my pick in my managed accounts and newsletters I recommend for data storage. And their sales are supposed to be up 18.5%. Their earnings are supposed to be up 39.8. They have positive analysis revisions. They do have a good surprise history. So that's why this stock ended up in my portfolios versus Western Digital. It just looks a little better across the board.
Of course, it wouldn't be earnings season without big tech taking center stage. Apple's results will hinge on service growth and global consumer demand.
Yeah, Apple's interesting. First, their sales are supposed to be about 11.4%, which is excellent. Earnings supposed to be up slightly more, again, 11 plus percent. Analysts have revised their estimates higher. That's a good sign. And Apple does have a good earnings surprise history, due largely to its expansion in the services. Now, what's interesting, when Jerry Bruckheimer made the Formula One movie, he put it out to studios to bid on it, and Apple won the bid. And now Apple's going to provide the Formula One coverage starting in March. And so they are definitely expanding services, and Apple TV is becoming a bigger and bigger deal. But obviously, we buy cloud storage from Apple. They have that app store that's very lucrative for them. So there's a lot of good developments underway for Apple. There's also gossip that they're going to change their CEO because Tim Cook's 65 and might retire. I don't know. Tim Cook looks in pretty good shape to me, so I think we ought to let him work as long as he wants. There's a lot of death at Apple. The other thing that's interesting, Apple is starting to move more to Austin, Texas. They haven't quite abandoned Cupertino yet, but they are embracing Texas as they grow. So it's a very solid company. Your mom owns it in her personal portfolio, and I think the most exciting thing will be out will be in September when they announce the iPhone 18. But right now the sales of iPhone 17s are very strong.
Meta continues to balance ad growth with heavy AI investment.
Meta's a little odd. Their sales are supposed to be up 20.7%. Their earnings are supposed to be up only 2%. They had a big miss last quarter. I mean, a big miss. And obviously the metaverse never worked. I don't know if anybody's left in the metaverse. Maybe Mr. Zuckerberg's still there. But they are spending a lot of money on AI, which was the main reason they missed last quarter. And they are trying to be an AI pioneer. The thing that everybody should know, even though Meta ranks okay in my system, I've never bought it. And the main reason I've never bought it is a high beta stock. And I prefer low beta, high alpha stocks. I prefer stocks that zig when the market zags. Meta is hypersensitive to the market overall. So it's not exciting to me right now, but if they give good guidance, it will be rewarded.
Microsoft remains the backbone of enterprise AI, so expectations are quite high.
Microsoft is a little like Apple. Their services keep selling very well. The sales are supposed to be at 15.3. Their earnings are supposed to be up, 21.5%. So that's good. Positive analysis revisions, very good earnings surprise history. The only thing that's holding Microsoft back from time to time is it hasn't monetized ChatGPT as well as a lot of people thought. And now, of course, ChatGPT has a lot of competitors with Gemini from Google and other services out there. Good bellwether stock, should surprise. But like any tech stock, they must provide good guidance. The only glitch is Microsoft Outlook had a horrible outage last Friday. And it affected a lot of people, and now there's a lot of phishing emails because apparently it was done by hackers. So this is most unfortunate. And Microsoft is required to have their software to be open source in Europe. And when a software is open source, it's more vulnerable to hacking and things. And that's exactly what happened to Microsoft. So hopefully, with the help of CrowdStrike, they can build their firewalls a little better. And we'll see. Hopefully this never happens again.
Tesla's margins and demand trends remain front and center.
All right. So here's the deal with Tesla. Their sales are supposed to be down 3.9%. Their earnings are supposed to be down over 38%. They've missed the past 4 quarters, and no one cares, because all anyone cares about is Elon's vision for robo-taxis and autonomous driving, and of course, eventually the Optimus robots. So Mr. Musk is a visionary, and he did this production at Hollywood Studios, showing the future, the robo-bus, the robo-taxi, ominous robots serving us drinks and appetizers, and he painted a picture that got everybody very excited. Now he's trying to fulfill that picture, okay? And it's tough, okay? But he obviously does a lot of amazing things in other businesses like SpaceX and all. So we will see. So this is a very odd stock because it trades on Mr. Musk's guidance. Now, with that said, their battery storage business is wonderful. They're rebuilding Moss Landing, which caught on fire, and which is a huge battery pack, and in the Monterey area. And again, their power storage business is excellent. But we'll just see if Tesla's going to be the eventual winner.
ASML should give us a global read on advanced chip manufacturing.
Okay, ASML is, of course, a lithography company in the Netherlands. They can etch the wafers to be for all the high-end chips, the Blackwell, the Vera Rubin chips, all the high-end chips, the ones we have in our Macs, and the Microsoft Surface laptops. So they make the good stuff. And of course, TSM makes most of that for everybody, but they have to do the chip etching. Their sales are supposed to be up a little over 3%, earnings are supposed to be up a little over 10%. And it should surprise, but it's just not exciting me right now. It just doesn't have the fundamentals I demand. But it is a very, very important company and a very well-run company.
KLAC's numbers reflect semiconductor capital spending discipline.
Okay, KLAC Corporation, of course, is a semiconductor equipment supplier, and their sales are supposed to be up a little over 3%. Earnings are supposed to be up a little over 8%. Decent analyst estimates. Provided some preliminary results. Got some people excited, but again, sales and earnings are not strong enough for me, so this is not on my radar right now, but it's in a good sector, and we wish them well.
TXN offers insight into industrial and automotive chip demand.
Well, this is Texas Instruments, and they make all kinds of low-grade semiconductor chips for everything. Their sales are supposed to be up almost 11%. That's good. Their earnings are supposed to decline slightly. My only issue with them is they missed last quarter. Hopefully things pick up, but obviously a lot of our consumer devices, automotive devices, will have chips from Texas Instruments in those products. So I have hope for them with a stronger sales growth, but again, you won't see in my portfolios because the earnings miss and the lack of earnings at this time. And they never are that upbeat on guidance. So this is just a kind of a boring stock, to be honest with you.
Caterpillar has been quietly turning things around, benefiting from infrastructure spending and global construction demand. Can Caterpillar keep up that momentum?
I hope so. They had a huge surprise last quarter, and before that, they disappointed for a couple other quarters. But their sales are supposed to be up 10%. Earnings are supposed to be down slightly, but we do have positive analyst revisions on the stock. So based on what they did last quarter, hopefully they'll surprise and guide higher. But again, it doesn't have the earnings growth I demand. And this is a big multinational, and once you leave America, economies aren't as strong as they are in the United States. So they are going to be very sensitive to global GDP growth.
There's also growing concern around a proposed 10% cap on credit card interest rates, something JP Morgan CEO called an economic disaster. Now, for MasterCard, how exposed is MasterCard if caps are implemented?
None, because they just do the processing. So they don't have to worry about an interest rate cap. And of course, President Trump's trying to do that to help the bottom 50% of consumers that might have credit card issues. And he asked Elizabeth Warren's help on this. He's asked for this for 1 year from Congress. So we'll see what it gets. But I think Jamie Dimon should have played ball. They obviously, JP Morgan is not a predatory lender like some other credit card companies. Clearly, they don't want to cap their interest rates and curtail their profits. But I think most people think the 10% interest rate cap is a very, very good idea. And I would hope that it would have bipartisan support in Congress. With that said, MasterCard sales are supposed to be up over 17%. Their earnings also look very good, up about 11%. MasterCard, believe it or not, is bigger outside of America than in America. So they're more of a bellwether for international sales. But they have no interest rate risk, just credit card processing. And they do have a good surprise history.
And does Visa face a similar risk, or are these fears overblown?
Visa does not have the risk because, again, they just do credit card processing, so they have no interest rate risk. That's on the banks and the issuers. And they look slightly better than MasterCard. Just so everybody knows, Visa's bigger in America, MasterCard's bigger internationally. But their sales are supposed to be up 12.4%. Their earnings are supposed to be up about a little over 14%. Positive answer revisions, good surprise history. So, yeah, these stocks should be fine. People like their credit cards and they don't have the interest rate risk. So the other thing that's funny about Wall Street is when people give you money to manage, pension consultants, they often want you to buy in certain sectors. So let's just make an argument that the credit card companies are going to be suffering if there is an interest rate cap. Well, what will happen is the professional money managers might sell a Capital One and then buy MasterCard or Visa because they won't have that interest rate risk. So I would not be surprised if both MasterCard and Visa benefit from the 10% credit card interest rate cap if it gets implemented.
Dad, you just got a new Cadillac. What should investors be watching when it comes to General Motors?
Well, they're basically making money on their high-end products. The trucks, the Cadillac division is doing very, very good thanks to Escalade. But they just wrote down all their EV expenses. They make EVs. You can get an electric Escalade, you can get an electric Hummer, an electric Chevy pickup, a GMC pickup, and all. But now that bugaboo is behind them because that wasn't very profitable for GM. What's happened is they can now focus on what they do best, which are basically cars with big engines, and they're very powerful, and their truck business. And Cadillac makes very few cars. I bought one of the cars they make. It's a hot rod car with a 6-speed manual. It's called Blackwing. It should be a lot of fun. Unfortunately, I bought it and stuck it in the garage in Reno, and then it snowed, so I haven't driven it much. So I'll have to exercise it soon. So I expect GM to surprise because they've been doing that in their previous quarter, and the future looks very bright for them, especially with all the environmental restrictions lifted near term.
And Starbucks has announced store closures. What should investors focus on this quarter?
Yeah, they better be closing stores because they've missed 3 quarters in a row. Their sales, believe it or not, are supposed to be like 2.6%. Earnings supposed to be down 15%. Some of the store closures were more concentrated in California, where there's a $20 minimum wage now. Coffee is addictive, and so once you start drinking coffee, you kind of want it every day. And but there are high coffee prices because there's a drought in the equator, and that got the price of beans up. So maybe people are looking at Celsius or other caffeine alternatives right now. But until Starbucks surprises, it's not going to be doing very well. And they do have analyst cuts in recent months. So it's just going to be up to them to finally surprise. But yeah, the store closures are a tragedy, and there's quite a few of them underway.
Now, before we go, we want to give you all a huge thank you to our viewers for helping us hit 5,000 subscribers. Now, to celebrate, we're going to be giving away Louie's new book, The Sacred Truths of Investing. To enter, make sure you're subscribed, like this video, and leave a comment below telling us your favorite stock that Louie has recommended that has helped you find success. Then fill out the Google form linked in the description. We'll be randomly selecting 100 winners from all entries and may be able to give out more while supplies last. Thanks again for your support, and we truly appreciate every one of you. We will see you all this Wednesday for a new video.